The narrative continues to change. The yield curve this week with market higher was meaningless. So can this time really be different? What's up, everybody? Welcome aboard. It's Bubba's Bottom Line for Sunday, September the 8th, NFL opening day kickoff, or the opening Sunday. Obviously, the Bears choked it up pretty good on Thursday night as they stunk up the joint and got whipped by the Green Bay Packers. But here we are, and of course, last week, all the rage was the yield curve is inverting. Oh my God, what are we going to do? The yield curve is inverting. Or in other words, there's a problem. Oh, the markets are higher. There is no problem. So we are continued to be convinced that this time, that this market is different. And it doesn't matter that everybody's chasing everything, chasing yield globally, trying to find that magic spot. And of course, as you look at the different situations and markets, and of course, you've got gold higher, bonds higher, equities higher. Is that not the classic chase? But yet you will hear from many of the pundits, many of these so-called experts, that this time is different. It doesn't matter. And of course, we know that's the biggest crock of crap that you could possibly say and possibly listen to. But of course, many will listen to that this time is different and it can continue to do what it's doing. Now, again, we don't ever try to give you the gloom and doom scenario forever, because again, we do know that the markets do continue to go higher on a basis year over year. We've talked about this before. Markets typically go up on average about 8 to 8.5% year over year, just not every year. But, when it was going down, you saw the special ticker on some of the channels saying the 2-year, the 10-year, oh my God, what are we going to do? We're going, oh, I don't know. I'm not sure. I don't know. Maybe you should get Jackie Mason to come and do the yield curve bit. Okay. Because it's not, you watch it minute by minute. The yield curve does not determine a recession on a minute by minute basis. In fact, the yield curve is typically the last thing that finally convinces us or shows us that we are in a recession, which, we've said here for weeks that we already have started the recession. And of course, we talked well in advance of this yield curve inversion, and not that it's a major ordeal, because it's not. But again, we talked about this long before it became the storyline almost each and every day in markets and what's going on. But you've got a lot of things to look at. And as we now look to see our stocks breaking out now to the potential run to new highs. Okay, certainly we'll talk about more of this when we get to the markets themselves, but certainly based on the patterns, excuse me, that we talk about, based on the action that we have described on a day-to-day basis right here on Bubba's Bottom Line, the markets are probably going to make a run now. They have broken out of that miserable wide sweeping consolidation or congestion pattern. So as you remember, we do occasionally talk about the phases of the market, and that we are now in the breakout phase. Now, the real interesting story will they be able to continue? And again, we never try to tell you that a market cannot continue going in the direction that it's going, because as they build momentum, as they start to trend, which we're going to be looking for this market to possibly go higher, and to further our opinion, okay, we have our algorithms, which also suggest the market is going higher. As you know, we always disclose which side of the market that we were on, and we were on the short side for a while. We got basically neutral with the indexes. Now we're on the long side of the market, almost in full, with the exception being that we are short the Russell contract, but now long the Dow, the S&P, and the NASDAQ, okay? And of course, We've got all this kind of great news out there telling us how good the world is, and of course you've got the Chair Powell, okay, telling us that there's probably not going to be a recession. Now, you know, as we've said many, many times before, the Federal Reserve, the central banking system, the biggest joke and the biggest crock of crap ever, okay, will never get it right and never tell you that the recession is starting. They will tell you years from now, oh yeah, back in 2019, okay, we had started our recession. Well, again, you start to see reasons that there is this start. And what's one of the minor things you could look at now? Well, we just had a jobs number on Friday. Now, again, it's not that the jobs were horrible, not that it was bad, but again, some of the little things that come in with inside that report. So we see the average hours worked rising a touch, okay, but of course, we've got less people being hired again. So as we go back in time, okay, if we go in the Wayback Machine, okay, that is one of the signs as companies start to hire less, they let their current employees work a little bit longer hours. So you get that little bit of divergence from now not hiring as much to now giving who you have more hours. And if things do deteriorate, which we expect them to do over time, okay, and go through another period of ugliness. But as you see these things happening, this is just another little nugget that says, why have they stopped hiring? Why are they working more hours? And because that is as they start to weed back out. So as the pendulum is swung in the jobs market to 50-year lows in unemployment, there's going to be somewhat of a balance and at least retrace back to the mean. You know, one of the things we do know about all markets, about all things, is they do have extremes on one side or the other, but typically they will always have somewhat of a mean reversion. And of course, jobs will also have a mean reversion at some point because, again, we are not seeing the overall growth that we had hoped for. But of course, you know, again, when you continue on this road of really worrying about the money and really worried about the interest rate market instead of letting the free market trade, these are the types of things that start to show up before. And so when we do finally, and again, who knows when it's going to be? I mean, I'm long. So we're, you know, I'm certainly not rooting for it right now. But again, I know it'll come at some point. But when we look to the future, okay, and it finally does have the serious meltdown, you know, and everybody's going to wonder, well, what hit me? Why was I not prepared for this? But you're not prepared for it because you're not paying attention today, because you're not paying attention to the warning signs that are out there today. Okay, so you start to add these little things together, and all of a sudden, out of nowhere, you have a mess. But is it really out of nowhere? And the answer is, of course, no. It's not out of nowhere. It is something that has developed through time, okay, and then suddenly shows up, and then the numbers start to get bigger. So again, I am not telling you to act on anything. I'm not telling you to sell everything on. I'm telling you to get in cash, because we don't get in cash. We hedge the market, so we don't concern ourselves with things like that. But what you want to be understanding is this is the direction, and certainly you need to prepare some of your own personal things. For example, if you do have a lot of debt, okay, you want to try to get rid of as much debt as you can as we see things starting to change. And of course, the interest rates figure to continue to go lower as the central banks, okay, or the central crooks around the world continue to manipulate and screw with interest rates, and of course, negative rates all over. And as the Austrian bond, which we've talked about a couple of times, which started at 2%, is now down to about 1% for 100 years. That's exactly where I'm going to put my money for the next 100 years. Okay, at 1% in a 100-year bond. But you're starting to see that the liquidity is drying up as you start to see the talk about longer duration bonds. You know, it was just 3 or 4 years ago that we figured that they didn't need the 30-year bond anymore. Okay, so again, now they're talking about 40 and 50 and 60-year bonds. So corporations, should be borrowing as much money as they can right now because, again, basically you're getting the money for nothing. So this is, again, always the interesting things that we see. And, of course, we are now seeing, it started, as we talked about last week, the 3.5% mortgages with 580 credit scores. I mean, are you kidding me? Is this not an instant rerun? But now there are now stories coming out about the auto industry that they basically almost don't check anybody's credit. They check, about 10% of people's credit. Okay, so they're firing out cars. Why? Because they want to make sales, because they want their stocks to perform well. So they want to have these big sales, regardless of what the underlying picture is. And this is just another typical story in which we continue to watch. This is a constant reminder that if you pay attention and understand what's going around, you can start to see these things are starting to happen because you've got the same ridiculous attitude by many that this time obviously is definitely going to be different. And I think you look at the market reaction to certain pieces of news. Now, obviously, the number one piece of news has been the trade wars. And of course, this week, or actually the past week we just finished, as I was lounging in Vegas, was the trade war announcement, okay? And the market skyrocketed. Now, number one, the markets looked like they might want to rally anyways. But do we really want to say that we're really dependent on the trade war and that's really the big story? Because again, that would be another pack of crap. When you look at all of this stuff, I mean, take a look at the grain markets. Now, the grain markets continue to get destructed, and again, we'll talk about more of these in a few minutes. But they continue to get pounded into oblivion. Okay, and you would think that them being, if you listen to the news, the number one story is the agricultural markets and the trade wars and how much effective. Well, if the trade wars were going to be successful and they were going to solve and we're going to have this great deal, then why do grains continue to go down? Why did they not react positively as the markets did when that story came out that they're possibly going to meet in October? So it just goes to show you the power of emotion and what the people out there want to buy and what the imbecilic pundits continue to push out there to create an imaginary narrative of what's going to happen. Because again, these are stories. If you ever noticed, stories get placed at certain times to create certain reactions to markets. Okay, this talks about the potential of the painting the tape and other things, which we'll talk about a little bit later as well. In the meantime, this is Bubba's Bottom Line. I'm just back from Vegas. It's Sunday. It is September the 8th, and of course, I want to remind you that as we go to break here about the hedging class, we have our last class of 2019. We'll start on Tuesday night at 6 Eastern time. If you want to be a member, if you want to join up, please email me. If you want to see the recording, email me at bubba@bubbatrading.com. But again, look, I don't care if you hedge or not. Okay, I'm telling you that for your own benefit, for your fiscal and financial, and for everything that you're doing, if you're not hedging, you're making a mistake. But again, I don't force anybody. I don't want to twist anybody's arm. I'm just telling you, it's very simple facts. If you're not hedged, you're going to puke out at the worst possible time and take another beat down. But that is, as always, is up to you. In the meantime, you'll soon start to hear about our new relationship with Ticker Talker. And I will actually have a private room there where I can do some of my talks and teachings and things like that. But tickertalker.com, and I'll have you some more information for that. And of course, don't forget about our high school program at Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. Now let's get back to Bubba's Bottom Line with, of course, me, your host, Todd Bubba Horowitz. Welcome back, everybody. And of course, we are, as we said, just back from Vegas, an exhausting 2-day journey to the desert. But I think there's some interesting things there, which we're going to talk about in my commentary. But in the meantime, so what did we have last week? We had the markets exploded higher, right? Bang, zoom to the moon. Let's go. Now, again, we reversed, obviously, from our positions. We're long, we're not long at great prices at the moment because we're not playing for 5 minutes or for a day. We're playing for a longer term trend. And it does look like the markets did break out, okay, to the upside. Now, again, it's 2 days of a breakout so far. So the key is to watch, will the markets pull back down to the top end of that breakout and hold support? Will they continue to go higher and trend higher and go to new highs? Or will they fall back into consolidation and go back into that same wicked, ridiculous pattern? Obviously, nobody knows but the shadow. But based on the work that we do, based on everything that we do, we assume the markets are going to go and continue to go higher. I mean, really, it's basically that simple. We don't want to make it overly complicated. It basically says that markets have broken out to the upside. They should continue to go higher because when you look on the other side of that equation, okay, if you look at the grain markets, okay, which have been absolutely destructive. Now, again, we've been short for grains for weeks. However, I still believe and have said, so again, I don't hide from what I've said. I am short, which I've said openly, but also I do believe there's a much bigger rally coming. But it is kind of concerning when you continue to hear this supposedly positive talk on trade and the grains don't budge. And in fact, they go lower. And that's what you're now seeing. You've now seen over the last week, you've seen corn make new lows, which is disgusting in its own right. Okay, wheat make new lows. Now they've had a little bit of a bounce, but you're nowhere near anything. And soybeans are fairly steady, but still working and hanging to these lows. So again, I have to ask the question: if the trade news is going to be good, why are these grain markets getting clobbered? And of course, obviously, the simple answer is the sellers are in control, and of course they are, and they will continue to push their weight around until they can't anymore. But I think it'll be interesting when they finally start harvesting, they finally start seeing how much actually sellable corn is out of all this ridiculous USDA report stuff. Because again, the USDA reports and the Fed are like one and the same. Maybe it's the same person, doing both just in drag. I don't really know. But again, they still look to be in trouble. So again, still, if you're trying to buy here, certainly not a bad idea. We're short. I certainly wouldn't get short here now. I mean, I am short, but I wouldn't sell down here. But again, if you're willing to hold on to it, and I do say to all of my farmers and producers and friends out there that are in the physical commodity, that if you do have the storage space available and you can hold and don't have to pay for it, I would certainly hold. I would not be selling at these ridiculously low prices because, again, the markets will turn. And the question is the duration and the emotional state of those that own it, whether or not they can hold out and say it's the right thing to do. And I think it is the right thing to do. We've gone through this many, many times over the years of what we would do. And this is right here. We would be holding. I would almost be holding this as like a bank account or as a long-term portfolio. Okay, again, because I don't see it. I don't see, yes, we could go lower, but I think now the major risk reward is that we're going back up and to be short down at these levels. But again, we are short. We'll be there for a little bit. And of course, the cattle markets, a lot of, as always, from the pits of the skanky traders that do some things that, in the old days of taking advantage of folks to now the box beef and versus the physical. And of course, we're seeing a lot of things that are not extremely exciting for those, especially when you see how the industry is ripping off, again, the poor, innocent, small guy, okay? This is something that has been troubled me for years because if you look at the wholesale on the prices and you look at box beef prices, I mean, the relationship is ridiculous compared to where it should be and to compare to where it always is. But that does tell us that something is probably going to happen. And of course, the cattle just got plummeted at the end of last week. And of course, we like it. Our algos are actually long feeders, short fats or short live cattle. But we do look for them to go higher. Certainly, if you hadn't been shorted before, I would not be selling them here. I'd be looking for a spot to buy. I mean, yeah, they can go lower. But again, you get down to the old saying, which is high prices cure high prices, low prices cure low prices. And to me, certainly in live cattle, we're at prices that are ridiculously low. And I would expect, again, I'm not going to jump out and buy them tomorrow because our algorithm is still short them. But I would think that we're closer. Okay. And again, I wouldn't be giving anything away here. Now, again, as we look into the hog market continues to consolidate back and forth. So we'll see what happens. I mean, we're shorted a little bit, but also it could be starting getting ready to change. So we'll continue to watch there. And when you look at oil had an up week. Not a tremendous surprise because last week it closed right down to the bottom. Now, this week we're right at the top. So our expectations, although we were long oil, would be that we'd have some sort of little sell-off back down to the bottom end. Now, of course, crude could break out as well and then start to trend higher. But in the meantime, we're just churning, back and forth. And that, again, remember to understand the footprints that the markets are leaving so that you can then put yourself in the better or best mathematical position. Because at the end of the day, markets are mathematical. They are, like a geometric regression or a geometry problem. So continue to watch those things. So our expectation, even though we're long, is to see a little bit of a pullback. But certainly if we do break out, which we could, we'll continue to watch and see that pattern develop. Gold got clocked last week. And of course, after pushing up to new 6 or 7 year highs, got hammered late. And of course, as you may or may not know, I do write for Kitco, and I did not write Friday. And people asked me, "Did you not write because you didn't because you didn't want to talk about it?" I said I didn't write because I was tired. I didn't feel like writing. I don't have to write. I mean, I do it. I do it as a favor for commentary. Okay, it's not exactly what I do for a living, right? But I do understand the market, and again, nothing changed for me. I expected. Okay, and we've said it on Bubba's Bottom Line, on Bubba's Daily Update. I've written it that, hey, I expect a pullback to 1,500. Well, gold closed at 1,515, December futures. So again, I expect it could go a little lower before we start to see that pullback. Okay, we're still long. I mean, I'm not worried about it, not worried. It doesn't bother me, right? Because again, I'm trading mechanically anyway. So when it's time to change, I'll change. Now, silver did take a little bit of a beat down and actually did reverse to the short side. But we did mention that you saw the gold silver ratio, which was at 92. What got down to about 77 and is now probably going to push back into the mid-80s. And then we'll see overall direction. But I think if we add in one thing, which we don't typically cover, but copper, the gold copper ratio has widened out as well, which all that we're saying is that people and investors are chasing everything. And that's kind of what you're seeing, which is distorting some of these markets and what's going on. Of course, bond futures got pounded a little bit last week. But again, you're going to see, and your expectation should be, when a market goes either parabolically down or parabolically up, to see some retracement or some mean reversion coming back to the midpoint before making, again, the continuation decision. So this has not changed where we're going to sit based on our positions. We're still long the Treasury bond futures and the 10-year note futures, and we will stay there, okay, until, again, the methods change and it's time. But there is no reason to panic about it. And this is, again, we talk about the emotions of trading. And of course, you've got, many things. The dollar, it exploded. It got well over 99, as it tries to run to our target of par. And of course, we do expect it and maybe higher. Everybody forgets that, when President Trump got elected, the dollar was over 103. Okay, it went sparking higher. As you remember, the dollar is not only the currency, but it's also a fear asset that people do buy. Okay, as they go forward. So again, it's something that we look into and want to make sure that we understand how the market functions and how the market works. Forget about the overall correlations of what goes on, because again, markets may correlate. The dollar against commodities may correlate, but if you've been recently watching, gold, dollar, and stocks and bonds all went up at the same time. Okay, so again, don't get caught up in this crap that the pundits try to spew and spin with the yield curve, with this curve, with this, that. They know nothing. They have zero understanding of the function and how the markets work, and are just continue to repeat the same phrase. Well, the Fed's got to cut rates. The Fed's got to cut rates. And again, if the Fed would be eliminated, okay, then there wouldn't be a need for rate cuts if they would let the free markets decide. But of course, if they let the free markets decide, it makes it harder to make your currency and make your money worth less dollars. This is Bubba's Bottom Line. Todd Bubba Horowitz. We're going to step out here for a break, and we'll be back with my commentary about Las Vegas after the break. We'll be right back. So everybody, you're listening to Bubba's Bottom Line. You're watching. And of course, we want to remind you our last hedging course class for the year for 2019 starts September 10th, Tuesday, okay, 6 Eastern. If you want to be a member, you want to join, email me at bubba@bubbatrading.com. Again, no pressure. I don't care if you join or not. I'm just telling you that I hope that you learn how to protect your assets, okay, or protect your ass, okay, and then that's so that you don't have to go through the next major meltdown, which again, I don't predict when it's to come, but we'll be here, okay. In the meantime, if you want to hear the webinar first, certainly I'll be happy to send it to you. Email me at bubba@bubbatrading.com. And of course, soon you'll see us, one of our new sponsors will be Ticker Talker, which is a great site that has interactive trading and actually talks about and does a lot of educational stuff. So you'll get more information on that. And of course, don't forget about our high school program at Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. Now let's get back to Bubba's Bottom Line with, of course, me, Todd Horowitz, and I give you my commentary of Las Vegas. Welcome back, everybody. This is Todd Bubba Horowitz, Bubba's Bottom Line for Sunday, September the 8th, just fresh back from Las Vegas and fresh and pissed off. It's what is happening to that great town that I love, that town, if you remember the movie Casino, Lefty Rosenthal talked about, and the way that the whole system used to work. And of course, this is the corporate America taking over the next industry that was really, first of all, determined and built on relationships and people that you knew and how to let somebody make a decision to help somebody. But of course, Vegas learned, and again, listen, I have nothing against Vegas. I mean, I live there. I have a home there. Okay. So I have nothing against Vegas. Okay. In fact, I quite like it, but I do have a problem with what is going on to the industry. Okay, as a 45-year player in Las Vegas, okay, as of being there, I've been there, I don't know, probably seriously 1,000 times over my life, and lived there periodically for periods. I do have a problem with how the industry is now changing. Obviously, a lot for the better for the corporations. As we know, when you take out the individual ownership and you take out the individual relationship, which we've seen from the banking industry, to every other industry that used to have a personal touch that could actually make a decision to help somebody versus then going right to the book. So in Vegas, used to be, they would take care of their players. If you played, they would take care of you. You'd have a host. They would talk to you, and they would, try to help you out. And if you had an exceptionally bad trip, they would maybe help you out a little bit more. If you had a good trip, they might help you out a little less. But in the meantime, it was more subjective to the host and who you were dealing with that had an understanding. But since Vegas learned how to make money, they now screw you on everything from the room to the resort fee, which is, whoever dreamed of that, you are a genius, okay? Whoever dreamed of resort fees, okay, which is the biggest ripoff in history. But of course, you get $30 a day on resort fees. Some hotels are higher, but I mean, so now Vegas has the resort fees, which again they didn't have. Everybody pays for, not everybody, people pay for the room, they pay for the food, all the things that used to be more comped or given away to customers, okay, is now charged. So not only are they making money on your hotel part and on your gambling part, they make money in every department now. Which is, listen, I have nothing against making money. I'm happy that they're capitalistic, but again, they are somewhat in a service industry. But I think the biggest thing that I will say here is that I would venture to say, like trading floors, in 5 years there will no longer be hosts for the casinos like they have now. There will be a machine, you put your card in, and it tells you what your comps are. And that's the end of the day. But I also believe that some of the changes are, and this is what really irritates me, is they have changed some of the odds especially on the strip, Okay, blackjack at these smaller level games, which more people play these smaller level games, has changed from what it's supposed to be, which is 3-2. They now pay 6-5. So they're ripping off the customer once again. So not only do they get you at the room, this resort fee, food, and everything else, now they got to steal away a little bit at the tables where they already have a tremendous edge on your gambling. Now they have to steal a little bit more. And I think that's a crack. Okay. I think that is the biggest. In fact, I personally will not stay at those hotels on the strip because I think that it's a joke that they're ripping off like everybody else wants to rip off the average guy on the street. And of course, if you remember Joe Pesci in the movie Lethal Weapon, they in the drive-thru, okay? And that's what they're now doing to you in Las Vegas. This is Bubba's Bottom Line, Top Bob Horowitz. Enjoy football. It's Sunday. It's opening day. I can't wait. Fantasy, gambling, the whole thing. We'll see you back here tomorrow at Bubba's Daily Update. Have a great Sunday, everybody. Thanks so much. We'll see you tomorrow.